Good afternoon, everybody. Welcome to this webinar by Scope Ratings on European commercial real estate. My name is Dirk Brandenberg. I'm Scope's head of credit research and ESG, and I'm joined today by Philip Voss, who is an analyst in our corporate rating franchise specialized on commercial real estate or real estate companies in general. And then I also have the pleasure of Florent Albert, an analyst from our structured finance franchise who works primarily on commercial real estate loans and a lot of the private side of the business. I will kick it off with a brief observation on our overall macro view here, which I think is quite important for the discussion that Philip and Florent will lead. The main points here are that currently, like a lot of other houses, we do expect quite a significant economic slowdown in Europe. We still see the euro area growing slightly above 0% next year. Biggest downside clearly in Germany, which we see shrinking next year for the whole year, actually not only over the winter. And we also, in terms of other real estate markets, we have currently a 0% growth outlook for next year on the UK. Clearly, we're holding our breath here. It's a developing situation. And we also brought back our US outlook to 0.5% for 2023. Slightly different story there around more the risks of monetary policy, while in Europe, clearly the risk here about energy and inflation and also on the general aggregate demand. One other point here, which is important, especially I think for this asset class, is the interest rate outlook. We have looked at both here the growth and the inflation picture, and I think one of our main observations here is that while there is some downside or some relief really on headline inflation rates ahead eventually, we do expect a fairly consistent high pressure on core inflation rate, which means that central banks also will probably err on the sort of upper side of their current rates guidance. So I think what that means for euro, we see rates peaking at around 3% at the moment in 2023, or at the peak of that cycle. US above 5%. And then on the UK, we currently have no outlook because we're reevaluating the situation. Clearly, this will be closer to the US picture than the European picture. Hopefully not far above the US peak of 5%. So both these factors, low growth and rising policy rates, they clearly have a potentially negative impact on many asset classes, but being very long dated, real estate is here particularly affected. That's why we're calling this webinar today. And with that, I will hand it over to my presenters. Florent Albert will kick this presentation off, and Philip will join after him. Florent, you want to go ahead?
Yeah, thanks, Dave. Hi, everyone. So to start this presentation, I think we would like to have a first poll. So Arvin, if you can show it to the audience to vote on. So the first poll is, what's the biggest threat to the real estate values? Access to external financing and refinancing, rising cost of capital, both on debt and equity, and the cost inflation, inability to pass cost through to tenants. I let you vote, and at the same time, I'm going to present the first slide. So I think it's always important to look back before to judge on a situation, and looking back at the last years since the GFC helps understanding the current situation. So on the macroeconomic environment front, what we have seen, if we were to split the last years into kind of three buckets, post-GFC, COVID, and Ukraine crisis. So post-GFC, including also the sovereign European crisis. What we have seen is an economy that has been stabilizing and then expanding, combined with accommodating fiscal and monetary policies and dynamic labor market that led to decreasing inflation rates, decreasing yields, and increasing rents in general. When the COVID crisis came, we suffered or faced a demand shock that turned to a supply chain disruption risk or that actually materialized. And getting out of the COVID crisis, we entered into this Ukrainian crisis where to that we add the energy crisis shock plus the geopolitical risk that led to higher inflation that governments and central banks are trying to fight against with tightening fiscal and monetary policies. In the meantime, the last years have been interesting from the standpoint of structural changes. We have seen the macro trends around decarbonization, decentralization, digitalization, change in consumer behavior, in living behavior, in demographic changes, and recently the working from home experience. On the real estate financing side, we have seen the increasing market share of private and direct non-bank lending that grew, for example, from 1-2% around the GFC to being the largest provider of financing in the UK nowadays. An increase of liquidity due to also the action of the central banks, and finally, lending policies that have nothing to do with what happened during pre-GFC, but still that were quite relaxed until the Ukrainian crisis, and then now tightening. So with this picture in mind, we are going to approach a couple of questions today. What are the effects of this ongoing paradigm shift to real estate and the different property types? What are the impacts for corporate versus CRE loans? And what are also the impacts in terms of funding needs? So before to go to the next slide, maybe, Erwin, we can see the first results of the polls.
Yeah, the poll results are, we have 46% saying that the rising cost of capital is the biggest threat, followed by access to external financing or ability to refinance existing deals. That's 31%. And then the last point is cost inflation, which is the ability to pass through the cost to tenants, which is the least concern here with 22%, Laurent.
Thank you, Dirk. I hand over to my colleague, Philip.
Okay. Yeah, also a warm welcome from my side here. And actually, the question is nowadays, how will pricing of assets react? So specifically real estate assets, as we see cost of capital is already increasing. And we will touch base on the increasing cost of capital later on, so including equity and debt. And I guess now it's time for a second poll, Arvin, if you can put up the second poll with regards to the market value correction. Because we are pretty much interested in your view, what will be the likely market value correction going forward of real estate assets in general. So on this slide here, actually what you can see on the right-hand side is the spread in between prime yields in the office, retail, and industrial market, as well as the combined yields to, let's say, risk-free investments like AAA rated Eurobonds with a 10-year duration. And what we can see, of course, here is the spread is declining towards the end of Q2. So this is actually the right marginal here at this page. And it's the lowest spread since the peak of the Euro crisis in 2011. That is not worrying in itself, because if we look also at the observation period in almost 15 quarters or 4 years, spreads have been tighter. But what is worrying is actually the pace of this spread tightening. Yeah? So since the end of Q4 last year, we saw a steep, so to say, decline in spreads of around 160 basis points. And it will not come as a surprise to you if we would extrapolate this into the Q3, where we do not have any, not all the numbers yet available, the spreads even tighten further. So as asset values typically react with a delay of 12 to 18 months, it needs to be seen actually how this will play out on cap rates. And we need to have in mind as well that if we look into more liquid assets, they're pretty much also linked to the cost of capital. And if we look at, for example, debt capital costs, we see an inverse yield curve. So actually short-term interest rates are expected to be higher than long-term interest rates. So the picture might be a bit different 12 months down the road, but not significantly. So, but what are the consequences actually of that here? So first one is, of course, investors seek for a risk-adequate premium over their risk-free returns. And thus, we would expect the widening of spreads, but the question is to which extent and when. And this pretty much depends on the property type and the property quality an investor is invested in the real estate world. So generally, what we see is a pressure on valuations. Some could argue, of course, we are in an inflationary environment, and this is the right time, as most leases are linked to consumer price indices, to also push up rents. Yeah, that might balance off some of the pressure from widening yields, but we believe this won't happen. Yeah, so generally, rent increases won't materialize as quick as cap rates change, and second, rent increases also won't materialize in all asset classes to the same extent. So one exception here might be the industrial subsegment, where we saw strongest rental growth in the first half of this year, outpacing actually rental growth in the office segment by far, and also in the residential real estate market. And especially retail and office will suffer most actually from weaker tenant sentiment. And weaker tenant sentiment is driven by weaker credit quality, of course, but also by weaker demand for space in general, not only office, but also retail. So also not as a surprise, properties that yield the lowest cap rates right now will be affected most if rental cash flows are not low risk. And what we believe is low risk are AAA rated, let's say, rental cash flows over a long period. So having a 10 years lease contract with a government tenant, or being exposed to a regulated market like residential real estate in Germany or in France or wheresoever. So, and as a result of the lower property valuations, we will see a higher leverage for sure. And to put everything into perspective, we looked at a sample of 43 real estate corporates, and you can find the first findings on the left-hand side. And they show an LTV of between 20 to 50%, and the median LTV is 40%. And the question now is, how does it actually potential value deterioration, how will this impact the credit quality of these real estate companies? As mostly the secured and unsecured financings are linked to some financial covenants, among them also LTV thresholds, mostly 60%. And what we can observe, if we just do a back of an envelope calculation, just assuming spreads have to re-widen once again to a level we've seen post the global financial crisis and pre-COVID, so to around 400 bips, that especially companies that have a borderline investment grade leverage, so around 50% LTV or above, face actually the highest risk to breach leverage covenants. But most of the companies, at least in our sample, won't be affected seriously. So that means they will remain in the investment grade territory if it comes to leverage. Just assuming, of course, in the back of the envelope calculation, there will be no rent increase and no further increase in risk-free rates. Both, of course, is totally unlikely. But the general observation is everything will result in a weaker credit quality. And let's see at the polls actually and what people say about what will be the likely value corrections. So minus 10 to 20% actually was voted by 49% of the audience, 0 to minus 10% just by 26%, 20 to 30% by 80%. And there will be also some people that believe prices will rise. And there are also some bearish people that think there will be devaluations by more than 30%. So generally, actually, the audience expect some value corrections, but not maybe these doomsday scenarios. Some analysts are just riding on the ball. And with that, I hand back to Florent.
Thank you, Philip. So moving to the next slide, where we have here considered and looked at the public REIT market versus the public CMBS market. So first of all, looking at the REIT market in Europe, we look at around 148 REITs, which is 350 billion of capitalization. What we can observe since the peak in January 2020 is that all asset classes are down from 9 to 52%, with industrial and diversified REITs overperforming peers. Interestingly, retail and hospitality that were considered the kind of COVID-19 losers are not performing so worse than multifamily and office REITs. The main consequence of that is the cost of equity has increased as a result of this drop in market share. Now, moving to the securitized loans in European CMBSs and looking at slightly different period, i.e. all the CMBSs that have been issued since 2017 until Q1 2022 performance, and looking at it from a loan to value and ICR perspective or income perspective, sorry, value and income perspective, what we see is on that side of the chart, all the green points which show a reduced income and a reduced market value are retail or hotel loans. However, we also see some office loans and some mixed-use assets that have experienced a reduction in income, but no repricing or repricing of their market value. So we expect, as it's usually the case, that obviously the REITs are marked to market, so react faster than the loan market. But we will expect some correction in values, not only coming from the underperformance of some of these loans, but also on the repricing of the yields in general. And that more than ever, the convictions of lenders and borrowers on the macro trends, on the asset selection, and the tight underwriting criteria will be key. The changing of collateral value will lead to potentially property disposal or refinancing that are going to be happening earlier than planned, or equity injection to deleverage the assets. So I will let my Philip comment on the next slide, which is around the term risk.
Thank you very much, Florent. And yeah, term risk. So with regards to cash flow, how well protected are cash flows? To sum it up beforehand, you can see it already in the title, actually, the short to medium term risk with regards to cash flow is pretty limited. So what we can see here is, of course, the all-time low cost of debt we have been exposed to within the last decade was extensively used and appreciated by all the borrowers, sorry. Especially REITs made extensive use of the QE-driven low interest rate environment until the end of last year. So with some exceptions, we see that companies fixed by a very high share of their debt, actually, and also have relatively long weighted average debt maturities. And this results in a relatively strong EBITDA interest cover, or ICR. So this is from, again, the peer group of 43 real estate companies we looked at. On the other hand, you can see on the right-hand side, we now have a very, very steep increase in financing costs, actually mimicking the steep increase in the pricing of the AAA rated Eurobonds. And what are the consequences of this? So if you look at the left-hand side again, you see, okay, low interest rates have been locked in for a prolonged period. So actually the increase in interest rates will affect property companies only gradually over time. And again, we made a back of the envelope calculation. What does it mean if the companies refinance all of their outstanding debt within the next 6 years with at the heightened cost of interest? Actually, for the normalized peer we look at here, they won't leave investment grade territory if it comes to the EBITDA interest cover, at least not for the next couple of years. So there is some time to actually grow into this changed environment, especially as we also believe that rent increases will be possible, not across all asset classes and not to the same extent, but it will be possible. However, especially companies facing a high leverage, short-term debt durations, and relatively high shares of floating rate debt will be affected very seriously. And by no surprise, these are predominantly development companies, as well as some high-profile Nordic real estate companies. Yeah, both of them actually used a lot of floating rate debt and have also exposure to very short-term debt durations. Another consequence actually of the increase in financing costs is what we also see. There's an increase in spread in between capital market debt and bank debt again. And after the global financial crisis, a lot of companies shifted their liability structure towards alternative lenders and capital market debt refinancing. But given the highest spread we see and we believe to increase even further, those borrowers will be tempted to go back predominantly to secured financing, even if this comes at an increased cost with regard to other stuff like higher management attention needed and a reduced portfolio fungibility. And with that, hand over again back to Florent.
So now looking at medium-term and refinancing risk. The all-in refinancing risk at 5 years, which is a traditional tenor for loan financing, is now at 6.4 for GBP and 5% for Euro. So what does that mean? That means that for the first time for a long time, the borrowers will be exposed to negative returns with a cost of debt that will be higher than the investment yield. i.e. the investment yield you see in this chart, which is in dark blue, and the spread over the investment yield on the debt side being on the light blue. So this has a consequence to create lower cash on cash yields, and for borrowers, it will be extremely important to pass costs through to the tenants. Otherwise, they will have to deleverage ahead of refinancing or at refinancing and inject either equity or dispose of assets. However, some of these costs won't be passed through the tenants, especially on some asset classes, due to inflation, risk of recessions, affordability risk. And therefore, this will create additional risk at refinancing for borrowers. Ultimately, the structures that we have seen so far on the loan market are not always optimal also to help deleveraging. In the recent years, we have seen optimization of covenant calculation, senior cash trap covenants ranking junior to mezzanine financing, or mezzanine debt servicing, cash trap used at the discretion of borrowers, etc. And these mechanisms will lead to a lower deleveraging than expected ahead of refinancing. So now, if we were to consider an average financing loan at 60%, in order to bridge the gap to the 1.3 times ICR that is often considered to the minimum healthy ICR, debt levels should decrease to 45-50% as a kind of back of the envelope calculation, or asset value will have to drop by 20-30% to, when they refinance, have the loan to value healthy loan to value around 60% and ICR at 1.3. So this is a significant market correction in order for the metrics to be back to the 1.3 minimum healthy levels. On the stock of securitized loans, there is no short-term refinancing wall. However, we see the retail market as well as some hotels, hospitality loans are going to test the market soon. And interestingly, some of these loans are already in covenant breach. We think about Magenta, Helios on UK hospitality CMBSs. We think about the refinancing default recently of Emerald Italy, the Italian shopping center. So all of that will create additional need for refinancing because both the loan acceleration or LTV covenant breach will result in earlier than planned refinancing or restructuring. In addition, the current inflationary environment will increase capex budgets and therefore needs for refinancing, for financing, as well as delay property leasing or sales. And from a lender perspective, they will prioritize refinancing or restructuring of the existing book before considering any refurbishment, repositioning, or repurposing projects, and finally development projects. In this panorama, we also need to add all the loans that have been waited to be refinanced post-COVID because the assets were not stabilized. So ultimately, that presents a significant need for financing for the near future, without forgetting that the environment regulation and the needs for an increase on the, for example, on the EPC certificates will create additional pressure on getting financing for borrowers. Moving to the next slide, and keeping in mind what we mentioned of the 5% and 6.4% rates, or all-in rates, we see a couple of loans that are already that will already be considered being at risk. So this is especially for residential assets and for office assets. So here we have in mind ELOC 39 House, some of the Sage social housing transactions, the office River Green, Taurus 2021 DU in Germany, etc. If we were to consider a loan to value, the market value to correct by 30%, that will write off any kind of positive equity into some office deals and residential, and be quite close from some of the industrial portfolios. So the first ones to be impacted will be Taurus 2020, Sage again, Pietranera, Arrow 2018. In the other hand, some of the mixed-use assets will be more protected, as well as few offices. But as we have said, they are more of a concern from a yield perspective. I hand over again to Philip for the next slide.
Okay, and before we actually move to the next slide, Arvin, I would like you to put the next poll on, and I won't actually show the next slide until we voted on that, because the next slide will actually focus on that. So what do you believe, which real estate asset class is most affected by the current market environment? Yeah. So wait a few more seconds until we have majority of votes already. Okay. So from people attending, actually we have already the majority of votes, and actually most people of you believe that retail and office properties, yeah, they're combining roughly 2/3 of your answers, will be the most affected. And now let's move on what we believe. Yeah. So on this slide, you can see, of course, a differentiation between real estate companies and CRE loans. because for real estate companies, we rather look at the portfolio, and for CRE loans, rather at the single property. And within the portfolio, of course, you have more possibilities to arrange, or to adjust your liability structure by just being more active in trading your portfolio or not. So therefore, I also highlighted that we now look at the cash flow resilience, but also at the asset value resilience or leverage resilience for the real estate companies. And of course, there is a common understanding in between the two, so real estate companies and CRE loans, if it comes to development. So the developers are in a very difficult situation right now, but we also have some differences, especially if it comes to multifamily, where in the corporate environment we see the higher cash flow resilience and also a higher, let's say, resilience of leverage. And I will come to that in a second. But we will also focus a bit more on retail, where we believe in the corporate world in a higher leverage or asset value resilience in comparison to a single property assessment. Maybe I kickstart with multifamily and hand then back to Florent to also explain why multifamily is seen different in the CRE loan world. So with regard to multifamily, if it comes to cash flows, actually what we see is why we believe it's more or less pretty resilient is mostly these multifamily cash flows are exposed to regulated markets. Yeah, there are some exceptions, of course, in the UK, for example, but these regulated markets provide some good downside protection with regards to cash flows. If it's unregulated, of course, if the economy is going down, people also are tempted to pay less. So during COVID, we have seen this. So the most volatile markets have been the UK and the US if it comes to rental cash flows. And another factor actually that protects cash flows is the ability to pass on the inflationary pressure to some extent to the tenants, given the limited supply in most major markets. So you can see that development companies are screwed, so there will be less development, and thus people are focusing on lease markets, and also potential home buyers that have been able to actually acquire a property up until, let's say, the end of Q1 this year are returning to lease markets as financing costs are skyrocketing and they cannot shoulder this any longer. And if there is stress on the tenant side, as this is a basic human need, what we believe there will be some support by governments with some government interventions, paying heightened energy bills or whatsoever. With regards to the value, what we believe is the protecting factor here on the corporate world is that the current value for the companies we look at is mostly below the reinstatement costs. So reinstatement costs are 15 to 40% above the value the companies have on their balance sheet. And we also believe, as I highlighted, in a constant growth of rents, and this will balance off some pressure from the widening yields. And we also see that there are still some investors that accept lower risk premiums. And this is a very low risk asset class. And thus, there will be some investors that are still willing to buy in to this asset class at a 3.5 or 4% yield. And last but not least, and this is also true actually for then the retail world, if you're a corporate, you can play around with your portfolio. What we see here is that companies are thinking about disposing parts of their portfolio to joint venture structures, inviting these investors that accept lower returns on their investments, but keeping the majority. This will release some capital that will be used to repay debt, or they can also dispose properties in full. But yeah, this is the corporate view, but for what is actually the view from the CRE loan angle?
Thanks, Philip. So from a CRE loan angle, I think, first of all, there is a lot of nuances in the market, and we need to split multifamily within different subsectors. But without getting to this level of details, I think there is no question that the demand is there, and the supply and demand and balance is in favor of residential sponsors. However, the main risk is for them to not be able to pass through the entire increase in cost to the tenants because of government intervention that will try to regulate and to limit the or to try to not worsen the affordability ratio for the tenants, especially for the one with low income. That's one. Secondly, the residential market is the one having the lowest yields, and therefore, as the yields are going to move out, the value is the ones that are going to be the most impacted. So we have recently seen residential financing at 70% LTV with low 4% yield. These type of transactions are going to be potentially quite affected. The third point is, with new regulation around EPC, there will be a significant need for capex investment, and the return in value of this capex investment may not crystallize and to the extent that to the level that the borrowers would like to. And finally, with the current financing appetite from banks, they will probably show less appetite to finance non-stabilized multifamily portfolios. Do you want to continue with retail, Philippe?
Yes, sure. I totally agree also with less appetite for non-stabilized multifamily portfolios. One thing I would like to add is, of course, these capex, depending on the regulatory environment, could be passed on as rent increases in some jurisdictions. So this directly feeds into higher rents, higher cash flows, and thus also some limited concerns with regards to the stability of asset values. But with regards to retail, actually, we are pretty much aligned if it comes to the resilience of cash flows. So they're not as resilient as they are for multifamily. But with regards to the asset values, we have an opposing view, and it all predominantly also stems from the portfolio view here. So actually, we believe that retail crossed the valley. So the major value corrections, and the necessary adjustments on yields kicked in from 2019 as the consequence of a heightened obsolescence risk. And this was a bit amplified during the COVID-19 crisis. And if we look at the like-for-like value changes of the retail REITs in the first half of this year, we see that these have been very limited and rather positive than negative. And what I just said also, if you have a portfolio, you can play around with that. And if it comes to leverage, you have some good mechanisms to protect actually your leverage. And the most simple one is actually, which is bad from a CRE loan perspective, but good from a corporate perspective, to hand back the keys. If you have secured financing, it's mostly non-recourse, and we see some issues that just hand back the keys for their stranded assets. So they get rid of these. As a consequence, they reduce indebtedness, and also the debt service they have to pay. So overall, it's beneficial to credit metrics. You cannot do this, of course, for the entirety of the portfolio, but for some very weak and stranded assets, this is possible, and it won't also harm your reputation if it's, especially in the market, you want to exit anyhow. But Florent, what is your view? Why you believe actually asset values are still under pressure here?
I think as for multifamily, there are nuances to draw. Probably outlet, essential retail assets are going to resist from an asset value standpoint. However, shopping centers, for example, have not seen in continental Europe the same value correction as in the UK. And the threat of e-commerce that is rising everywhere, especially after COVID, is, from my opinion, creating additional pressure on the value. An additional point is sponsors of retail assets have suffered multi-years of underperformance, and their capability and to raise additional funding or to have enough equity to invest in these assets to make them more suitable to resist to e-commerce is on doubt for some of the projects we have recently looked at. In the meantime, prime assets with the right footfall, with the right tenants, are resisting quite well. So the devil is in the details here.
Yeah, that's true. So actually what we want to highlight actually across all asset classes, there will be higher disparities between the good, the bad, and the ugly. Yeah, so like accepted or expected already at the start of the COVID-19 crisis. Cool. So actually, we would now like to enter into a quick Q&A session. So if you have questions, feel free to raise these within the chat window that is booked for questions.
Yeah, thank you, Philip. We already have a couple of questions lined up. There's quite a bit of focus on REITs here, from what I can see. And I think you put up your slide there, your fourth slide or the fifth in the slide count, where you go through the financing structure of REITs, and I think you picture this, so property companies. You picture this quite nicely there, right? You say the cost of debt 1.6%, fixed debt of that is 91%, average maturity of 6 years. So the question is, why should investors in REITs worry about rising rates at all at this stage?
So they won't be protected in general. So this is not what I say. It's just, of course, that the short to medium term risk is rather low on them, as they have some time to adapt to this changed interest rate environment. Yeah. So if they have good quality assets, cash flows will even increase to a level or will keep up with the widening of cap rates as well as the increase in interest rates. But still, over the medium term, of course, we will see a deterioration of the interest cover. But from a ratings perspective, we have seen a lot of these sky-high interest rate covers in the last couple of years, and we haven't paid that much, let's say, attention to that to come up with an assessment of the financial risk of the relevant company. Of course, the lower you get, the more riskier it becomes. But if you have a 10 times interest cover or 4 times, it doesn't really matter. So we look at different thresholds here, and with regards to that, they are well protected from a credit angle.
Okay, thank you. And how do you see the sort of the environment then in terms of REITs refinancing then? I mean, obviously slowly but surely here, and as we I think highlighted in my initial remarks actually, that interest rates are going to stay higher for longer, simply because the sort of inflation environment will remain elevated. Who could take on those assets from REITs? I mean, we had a situation where maybe 20 years ago, well, basically until the great financial crisis, banks were very active players in commercial real estate in general. Clearly, that has totally changed because of regulations and very high capital intensity. In terms of, who are the potential buyers here in the non-bank sector to actually take on assets or also refinance REITs going forward? Because it would appear to me that this is quite a different market environment for those assets than it was certainly during the last financial crisis.
Yeah, it certainly is. Yeah, but as I also highlighted, we have just a high multitude of possible lenders now in the market. Yeah, prior to the global financial crisis, it has been mostly banks, as you correctly stated. But nowadays we have alternative lenders, debt funds. We have also debt capital markets, where we just have normal investors investing into fixed income papers. And what we believe, as I highlighted, will be a return to secured financing. But if we look at the slide number, what was it, 3, and if we look at the median loan-to-value ratio of 40%, even if there will be some pressure on asset values, this is a totally different picture than it was prior to the global financial crisis, where we had been exposed to much higher leverage ratios. And thus, still, so to say, the golden way or golden path to go is via secured financing, as I guess for some of the assets, the loan-to-value is even lower. And if you have a portfolio of assets, as I said, you can dispose some of these assets, release some capital. There are some willing buyers, and even if at lower prices, you will have much more ability to control your leverage than if you're invested in just a single property.
Okay, all right. So I guess we're having a more diverse market environment, more diverse funding sources. Everybody suffering from rising rates, but we don't have this issue that just one financing group like the banks disappeared altogether, like what had happened the last time. So I guess that is one of the advantages in today's market environment. Let me move on with the questions. There's quite a few. I'm trying to group them. Maybe just to get another angle here, also from other aspects of the presentation. So we did have a poll actually around sort of which asset classes are worst affected here in the downturn. And so one asset class we haven't really talked about is sort of industrial real estate, logistics real estate, and the like. The question here is, I guess, particularly if you look at logistics, they were part of the big winner of again post-COVID, and they clearly went down to very, very low yields, which now are trading essentially below, or certainly the deals were done at yields that were actually below where some of the government bonds are trading today, for example, in the UK. So, Florent, I mean, how's that going to play out in that asset class? I mean, how much downside is there?
Well, first of all, hi, Peter. Thanks for the question. I think there's different way to look at it. First of all, in recent deals, we have seen valuers changing their assumptions on logistic assets, with the cap rates moving out a bit. So we already see a type of kind of small correction, even though it's still really at a really low level. The thing is, the outlook in terms of rent is pretty outstanding. So you could expect the cash flow to be pretty outperforming other asset classes, and to service pretty well with enough cushion the debt for the next years. However, the question will remain whether or not these assets valued at the right level, and it's a bit the same as for residential assets. But difference, from my point of view, is the outlook in terms of rents is much better for logistics. Obviously, they will still be impacted, as we have seen on the REITs, but probably to a less extent, given the outlook on rents.
Okay, thank you for that, Florent. If anybody has a follow-up question on this, very happy to take that. The one other point that's been raised here is around, I guess, the statement that refinancing risk is a big factor here, a big concern also for the audience. So one of the questions here is, to what extent can sort of different types of debt, into junior debt, instead of just plain equity, plain senior debt, sort of basically hybrid financings, how could they play, or could they play a role at all? I'm not sure what the demand is for that type of debt in this market environment, but is that something that could actually help stabilize some of these structures? I guess both on the loan side and potentially also on the REIT side. Florent, you have any views on that? or have you seen sort of mezzanine financing coming into deals?
Yeah, so we have seen mezzanine financing coming at levels up to 75% loan to value, with some structure that are quite aggressive in the sense that the interconnection with the senior debt is not that clean. We also saw recently some mezzanine financing putting out because the mezzanine lenders are taking a more cautious approach. So clearly there is quite a lot of movement in the financing side, especially for mezz lenders.
Okay. And a related question, probably more to Philip, is in terms of the ratings we actually have on these companies. I mean, you got the loan to value ratio here actually on the slide that's out there, but I mean, what's our sort of downside stress here with regard to the current level of issue ratings we have on these companies? I mean, how much can they take?
How much can they take? So it really depends on the individual company. So as I highlighted, the general, so to say, worst case would be that the spread between the yields and the risk-free returns would regain momentum and go up to 400 pips. So this would be the worst case scenario, but this will not happen overnight. So within our forecast, we rather look at gradual development and also with regards to how companies digest increased financing costs, the very same approach we follow with regards to reduced property valuations, so widening cap rates.
Okay, great. So just on valuations then, I mean, we had some pretty drastic views here from the audience on the downside of this market. But then also the conditions in the different geographies are quite different, both in terms of where interest rates are headed. So I mean, we talked a bit about the euro area, the UK, but clearly we also have other markets in Eastern Europe where interest rates are a lot higher already, and there's a lot more pressure from tightening financial conditions. So sort of, where do you see the main geographical sort of differentiation here in terms of asset valuations moving lower? Which locations are most affected? Where is there more leeway? I don't know. I'll leave this up to Philip. Maybe you wanted to comment on it, and then Florent, depending on your regional expertise there.
Okay, before I answer this question, I might just put this on here to see our geographical coverage, or to highlight this. And of course, we have a broad European coverage, but what we believe, with regards to devaluations, or where is the highest risk, it's more in the mature markets, I would say, or in the Nordics, especially in the Nordics, as they rely on the short-term refinancing, and they have been in a period of, 20 years or 25 years of continuous growth of property values. Whereas in the Central Eastern European countries, of course, you have there the hedge of your income. Mostly it's in euro for the commercial lease contracts. But on the other hand, you also have much higher cap rates already. So if you compare that, for example, a mall operator that operates in CEE has an average cap rate around 6%, whereas if it operates in the Western European hemisphere is around 4%. So, and this reflects, of course, already the risk, I would believe, we see, given the A, limited liquidity in these markets, and B, also the high inflationary pressure we see, and thus also the higher volatility of the economic surroundings there. So generally, I would say that the risk is more with the mature markets, where yields decreased drastically within the last couple of years. So just a 25 pips change in yields is more affecting property values if your cap rate was 3% as if it was 6 or 7%.
On the loan side, more than the geography, I think it's the property type and some sub-asset class as well. As examples, the more problematic structure and assets we have seen recently are quite surprisingly in Germany, with many financing secured by either development loans, development loan financing secured by assets that have budgets and that are completely out of the initial budgets, plus over delayed completions terms that make these loans completely problematic. We have seen various assets that are linked to education to be quite problematic following the hit from the COVID crisis and now the Ukrainian crisis. And in general, I think all assets that are exposed to, that are not top-notch assets are generally exposed to increasing operating costs and operating expenses. And in general, all tenants can't absorb the cost. We have also seen some student housing performing quite well in the opposite side of the spectrum. We saw some social housing performing pretty well, and then some markets like Ireland performing better than peers in general.
Okay, great. Thank you. Right, with that, we're getting on the hour, so I suggest we close the call here. I can't see any more question coming in. There's one more actually here coming, and that is about the valuations, i.e. what is a good way of valuing, or how do we consider these different techniques of valuation, i.e. replacement cost or comparable discounted cash flow analysis and so forth. I guess that's one for Florent, right?
Yeah, so on our side, our theory, loan methodology, and our model work as follow. We do an income valuation approach, i.e. our model discounts the future cash flows that we underwrite, so the 10 next years of cash flows, and then the cash flow at year 10 to perpetuity. In that way, it allows us to have a property value that is dynamically calculated, and that follows our projections in terms of cash flows. So we believe an income approach is the one that makes the most sense. We do back of the envelope or test or check in terms of residual value for development loans, as well as more cost value for some other projects. But the main one is income projection valuation.
Okay, great. Thank you. So with that, we'll close the call today. First of all, thank you very much to the audience. And then also, we very much value your feedback on this event. So you have a feedback window coming up here now, which you can answer. That would very much help us to tailor our offering to your specific needs. So thank you very much for that, if you find the time. And with that, I close the call today and hope to see you all soon again. Thank you.